Hello, listeners. My name is Rod Singhal, and welcome to another episode of Breaking Investment Stereotypes. This episode is brought to you by Multipie.co, where we believe that investing is an ignored life skill. Here at Multipie, our mission is to create a platform where people can come, learn, share, and collaborate through the right tools. Ultimately, we want your hard earned money to work for you. Here at Breaking Investment Stereotypes, our job is to deconstruct world class investors and wealth managers and deep dive into their investing journey, professionally, personally, or both. I want to give a little guidance on how to use these shows. None of the following should be treated as investment advice. Please see multipie.co/disclosures for more information. My guest for today is Andrew Holland. Andrew Holland is currently CEO of Avendus Capital Public Markets Alternate Strategies LLP. He joined Avendus Capital from December 2016. Prior to joining Avendus, Andrew was the CEO of Ambit Investment Advisors, where he built one of India's largest and most successful hedge funds. Before that, he was the managing director, Strategic Investment Group for Merrill Lynch in India, where he and I worked together for about a decade. Andrew was the CAO and head of research at Merrill Lynch in India. He successfully built DSP Merrill Lynch to a top research broking house, which got top ratings in Asia Money, Institutional Investors, and Greenwich. So without further ado, please welcome Andrew Holland. Hey, Andrew, welcome to the show.
Well, thank you for having me. It's a pleasure. Thank you.
Same here. So, I want to start with you, Andrew. I know that you moved to India in mid-90s to run research for Merrill, where, we have some great fond memories of the place. Why don't you tell us more about that and what made you actually make India your home?
Well, prior to coming to India, it's quite interesting. So I was actually working in South Korea, and I actually came here for a holiday. And I remember walking in Mumbai. Must have been 92, 94 or 93, 94. I remember seeing all these pieces of paper. It looked like newspapers outside a garage. So I thought, let me go and look at them. And there's all of these IPO kind of application forms. So I thought, India is really rocking. So it was always on my radar somewhere. And then I got offered the opportunity to come and work at DSP Merrill Lynch in 97. And I came really with that usual 3-year stint of moving around thereafter. But then I met my wife, who's from Mumbai, who was working at the Oberoi at the time. So actually virtually across the road from our offices, if you remember, Chandamukhi, I was in at that time, until Siani. And I suppose that the rest is history, right? Because she said I'm not moving from India. And but to be honest, it was a great time at DSP Merrill Lynch because I was heading research, as you quite rightly said, for throughout most of the time there. But I was also made the chief operating officer. So if you remember, I was looking at many different businesses. I remember in the debt business, we managed to get, I don't know if you went, but certainly some of your team went across to London to sit on the London trading desk.
Yeah, I did
so
go
that
there.
Was one of the happy, so that was one of the happy things that I managed to help, get the team to do. So it was a lot more interesting on the work front, both research and the kind of support side. And then, of course, in 2006, once Merrill's has acquired the stake, they asked me to start up the internal hedge fund. So you move completely to a new area, and to my mind, rather than telling clients, from research perspective where to put their money, I was putting the money where my mouth was, or Merrill's mouth was, in terms of our proprietary trading. So it was a great journey. I loved every minute of being at DSP Merrill Lynch, and I still pop in and see him and reminisce of sitting in his office because it hasn't really changed since we did it up in 1999, right? So that's the reason. One is obviously the work front was brilliant, and my wife, obviously telling me that this is where I am now.
Yeah, I know there is an interesting trivia, and this is thanks to Krishna here for reminding me of this. That I think it was on probably that historic weekend where Bank of America acquired Merrill, and I think you quit at the same time. So I'm sure of course, I'm assuming it was all coincidence, but happy to talk more about that.
Yeah, no, listen, I rode on the fact that I saw it coming, right, for many years. But to be honest, it was just pure coincidence. I kind of resigned on the Friday, and that weekend everything exploded and things changed overnight. But yeah, so I can't say I had the foresight to see that happen, exactly that event playing out. But yeah, I managed to kind of say, yeah, I could see that happening.
Yeah, that was interesting too. Yeah. Let's talk about the markets, which is your passion as well. So last 1.5 years, we have seen the way markets have performed. I'm sure everybody believed that stocks or stonks as they call it just goes up. And just seeing a data point that this is the longest rally in India without a 10% Nifty decline. What do you have to say for that?
I think it's the same in the US as well. We haven't seen anything near a 5 to 10% decline for a long time. So I think markets are overdue for one, that's for sure. But if you remember that kind of period of 2003 to 2007, what the Sensex went from was 2.5 to 20,000, something like that. But every year you had 1 month where the market would fall anywhere between 10 to 20%, and then would continue to rise thereafter. So at some point we will get this correction, which will kind of make us all concerned. But I think at that time, that 2003 to 2007, listen, a lot of people say we're in that same era, right, of 2003 to 2007 bull market. Now, the only one comparison I can actually agree with that is that if you remember in 2003, we're just coming out of SARS. And obviously we're now coming out of the pandemic, hopefully. But that's about the only one I can really kind of justify, because the P of the market in 2003 was 8. So it's really, really cheap. The growth in the world economy was driven really by China, which was growing at 10%, even more than 10% in those early years. And of course, for India, we had this kind of Capex cycle, which started to happen, but actually been happening prior to the kind of change government. BJP was spending a lot of money, and I think that multiplier effect really helped the Congress and the markets and that Capex cycle. We're not there in any of those scenarios at the moment, so it will be different in terms of the bull market this time.
Yeah. Do you want to call? I mean, from if you believe in that, or the corollary you said about 2003 to about 2007 rally, we are in which year right now? Are we 2004, 5, 6, 7? Where are we? Or you don't want to make that comparison at all?
Yeah, I think it's difficult to make that comparison because valuations are completely different. So we have to live with a high valuation. But I think I would say we're probably 2005, 2006. And the reason for that is that you're starting to see the growth pick up. Now I think the government can now, start doing the expenditure which they've been talking about. Then, the latter years, you'll start to see that multiplier effect of the Capex cycle by the government. And of course, you're going to see companies themselves starting to, through the PLI schemes or whatever, start to kind of put more capacity on the ground over the next 2 to 3 years. I think the other factor as well, that it's something that we talked about when the pandemic first happened, was that the kind of supply chains and companies working in China obviously wanted to kind of diversify or needed to diversify away from that going forward. So a lot of them went to Vietnam. Now Vietnam is actually shut down because of their lockdowns. So again, I think India's back on the radar in terms of foreign companies thinking there's 2 areas of real growth in the next decade or so. And if you think about it, it's going to be driven by millennials, right? Now, in the US, just as a reference, there's about 50 odd million millennials. In China and India alone, we each have over 330 odd million.
Yep.
So you know who's going to be driving the spending. So I think over the years, as companies look out for growth, they're going to say it's going to be China, but also India, where we want to start laying down, the kind of whether it's manufacturing or services, and invest. And that's what we've been seeing in foreign direct investment. So I think that's the kind of new catalyst we really didn't have in that 2003 to 2007 kind of period, where I think one is that India as a country, I think, will continue to attract both FII flows, but also foreign direct investment flows. That's the first thing. The second thing is that, again, because of China's regulations more recently and crackdown on technology in particular, that India, just as we're starting to see new wave companies, disruptive type companies come through IPO listings, I think you'll see again a lot more investors, coming to India. And if you looked at that Zomato, anchor list, it had the who's who of investors globally. So I think that's the trend which I will see. So going back to valuations for a second, whilst the PE was very cheap in 2003, if you think about the index, it's more of those industrials, manufacturing, metal companies. Today, it's a completely different index, which is why the kind of we didn't have IT and pharma in the index. I don't think, if I remember, back in 2003. Now you do, and I'm sure over the next year or so, a lot of these new age technology companies coming to the market will start to kind of be brought into the index going forward. So you might have to think about a higher PE going forward, because we're going to be a growth country in many different aspects.
You brought an interesting point around Capex as well. And, you mentioned about PLI, you mentioned about supply chain disruptions in China. Are we, we have seen that there have been a massive deleveraging corporates in the last, 4 or 5 years, where, the debt reduction is massive, including the large companies as well. Do you think we are at the start of a Capex cycle from the private sector?
I think we're kind of there or thereabouts for companies to start that Capex cycle. I think the fear at the moment is really about, is there going to be a third wave in India? And I think the jury is still out in that. The good news is that vaccinations have really picked up. So hopefully by the time the festival season in terms of Diwali comes about this time, enough people will be vaccinated so it doesn't become a big third wave. But I think that's the concerns at the moment for a lot of companies in terms of just laying down that new capacity or starting new businesses. So I think it's probably next year. But if the government can start their Capex cycle, which they've said they're going to invest very heavily, then I think that will push the GDP growth a lot quicker. And therefore, companies themselves will then follow on from that. It's usually always that way. So I think it's a next year story in terms of, and then it's obviously a long Capex cycle, right? It's not just a 1 year. But I think next year, I think corporates, if we come through the third wave with no real problems, there's no real problems with a third wave, then I think that gives the India Inc. the confidence to say, yes, we're getting growth. I mean, exports have been phenomenal, right? I mean, we haven't thought exports would be growing at such a rate that we're seeing today. But there's many more new industries, starting to come. And the whole of the financial industry, for example, we used to think about banks, right? And NBFCs, but now you've got asset management companies, you've got life insurance companies. Health is going to be part of what we're going to be thinking about and insuring ourselves about for many years. So it's a very nascent industry in that respect. So there's huge amounts of change, which I think is going to happen in the financial sector. And to be honest, if you're going to be a $5 trillion economy, you need to have a huge financial system, including banking system, to be able to support that. So lots of interest and lots of disruption in that industry as well, which is going to be interesting.
Oh, that's definitely, it looks like that way. Let's come to your, so you guys run one of the India's largest, hedge funds. Your absolute return fund uses both long and short strategies as well. What are some of the, and this is fairly new for Indian markets, right? This whole hedge fund concept. What are some of the misconceptions around hedge fund investing?
It's quite interesting because when we started this hedge fund in 2013, there's a lot of education you have to do to investors, because you're right, they read about some of the hedge funds in the West, and some are great and some are bad. But initially, their thought is it's more risky, right? It's a perception that it's more risky. But what we showed them, and if you think about India as a market, and I'm going back to my 97 when I came here, you would know earlier, but you really had two pockets of investments. You had debt or you had equity. Debt, low risk; equity, high risk, right? So on that risk curve, you had nothing else: low risk, high risk. So we wanted to go along that curve and say, can we introduce products which will take you along the risk curve? So when we introduced the long-short hedge fund, what we said was that this is a replacement for your kind of 2 to 3 year kind of debt, right? Because the volatility of our fund is around 3.5% per annum, right? Now, compare that to a kind of a bond fund, it's about the same.
Yep.
Right? Yes, I know you invest in equity, which is higher risk. But the volatility, as you know, of the Nifty is about 15% on average over the year. So we're 3.5%. Bond funds are 3.5%. Our drawdowns are very low. I mean, the largest drawdown we've had since 2013 is 0.95% in 1 month.
Wow,
right?
That's incredible.
So if you can deliver consistent returns to the investors, which is 2 to 3% above what they can get, say, in a liquid fund, a bond fund. And don't forget, in bond funds, if you're doing 3 year duration, you're locked in for 3 years, right? You can't without any kind of. Whereas in our fund, there's no entry load, there's no exit load, and it's monthly redemption. So it gave investors a lot of comfort that one, yes, they could redeem, and two, if the performance is there, they were seeing higher returns than you could do in some of the alternatives in the kind of fixed income. Kind of arena. So that's how we built it, and so I think it's been a lot of education. It's not just been us. Listen, Edelweiss, our old firm, DSP, in mutual fund. We've had Templeton, ICICI. So there's a lot more people out there, been educating as well about this. But I think SEBI did a very good thing of saying, the minimum investment has to be 1 crore. So you really go into the more sophisticated, kind of family offices, high net worth individuals, corporate treasurers, who kind of, do understand a little bit more about hedge funds.
Yeah, let's bring some macro picture here, right? I mean, we all are aware that Fed will be doing tapering sometime soon, and of course, at some later point in time, they will also be talking about interest rate hikes as well. And we are also, India will also follow a similar story. I mean, they're already withdrawing a little bit of a liquidity in a smaller way, and eventually interest rate hikes are going to come to India as well. So what do you think, how, and we have memories of 2013 tapering event as well on emerging markets, especially. How do you think, this will impact markets globally and specifically for India?
It's a good question. I think the Federal Reserve Chairman Jerome Powell has just done a fantastic job in setting expectations for the market. He's talked articulated about tapering, and his other Fed members done the same. So we're all expecting something maybe by December. But don't forget, it's 120 billion of bond buying, maybe going to 100 billion of bond buying. So there's still lots of liquidity sloshing around. And at the Jackson Hole symposium, what he did was even better, right? He said, we're probably going to taper, but I'm going to divorce interest rates for this conversation now. I'm going to say that don't Don't worry about interest. That's down the road. Don't even think about that. We're just going to do some type. So markets love that. Dovish about interest rates. Now, here's my dilemma with all of this, and it's this. First of all, is inflation transitory, which everyone is saying? There's two things that make me feel that I could just extend a little bit more. One is that the supply chain is still suffering. China's shut down. A lot of the shipping costs have been rising very rapidly. Commodity prices remain high. So all your input costs are going up. So either the companies can raise prices or they take a margin. So that's the first thing. So I think prices, inflation might be a little bit more sticky than people think. In the jobs data that came out last Friday, whilst the numbers of people was, in terms of getting jobs was lower than half of what the market expected, the wage growth was at 0.6% growth versus the forecast of 0.4. So now you're getting wage growth. So that's sticky. That, to my mind, is more sticky inflation because people have more money, disposable income, and they can buy more. So prices could rise. But let me just put a different scenario to you. Let's say that the supply chain starts to come on by the end of the year, right? With a little bit more force than it is today. Could it be that happens when the consumer is actually putting his hand back in his pockets and not spending, right? So will it be, we've seen some retail sales from the US, we're starting to see housing starting to fall. Has the consumer now bought enough? Yes, don't get me wrong, they have been traveling. They've been doing their experiences over the past few summer months in their areas. And if you look at the hotel bookings, it's all the resorts which are doing well. All the airlines which are flying to resorts are doing well. Business travel is still very low. In fact, I was in Delhi last week and I was staying at the Taj, and they have a very big kind of breakfast room area. But they had that open and another one open, and you still had to queue, right? Now, was it because of the social distancing and tables and so forth? It's because everyone there, apart from a few business people, were leisure travelers, right? Because we all still want to kind of do something different than sit in our homes. Now, once you've done that, it's a bit like saying, in Hong Kong, right? You open, you go to your favorite restaurant, but you're not going to go there 5 times a week, right? You're going to go there maybe once, you go to your usual patterns. So that initial spending might start to slow. So my question is, if that happens, global growth forecasts will have to be brought down. Goldman's have already reduced the US GDP forecast from this year, I think 6.3 to 5.7, if I remember. They've done the same in China. So global growth might be slowing, supply might be coming on, which means good news is that commodity prices will probably fall in that respect. But what will happen to earnings? Right? Because everyone's, it's low interest rate, good growth, the earnings are propelling the markets higher. What happens if there's downgrades to earnings? Could that be the thing that brings you that overdue market correction? The realization that earnings might not be growing as quickly as people were thinking. I think the second point is after central banks throwing all this money worldwide into the markets, into the economy, we can't sustain growth now. What is going to move growth? What is going to get growth going along the way? So I think that could be something that will be something that the markets start to think about more. Because if you look at what happened in Japan, right, and we know if it's 20 years now of really doing nothing, is that what faces the West going forward? That goes back to, I think that's why money flows will come to Asia, because when you want to see growth, you're going to see it in Asia, but you're particularly going to see it in India and China because of that millennial and the spending power. I haven't even gone to Gen Z. I mean, that takes you to, nearly half the population in India would fall into that category. So lots of different things happening, which I think is good for emerging markets, but that correction might just kind of spill over to risk-off trade.
I agree with you. I think, As they say, these are more like a Goldilocks situation, especially for the emerging markets, where because of this slower growth, Fed is going to stay put in whatever they're doing, which becomes positive for the markets as well, right? I think you brought in.
Interested just on the
Yeah,
emerging
sure.
markets. Just one extra thing there.
Mm-hmm.
Despite kind of India and other markets hitting highs, if you look at the relative performance to the MSCI, it's at one of the lowest levels in decades.
Yep.
Right. So we haven't, whilst we're saying we're doing well, we haven't really done that well as an emerging market investor.
Yeah, I think the EM index is probably still in dollar terms, still at 2007 level. So, yes. And thanks to China, probably most part of it, but still, I mean, if you look at overall, EM has done nothing. We are seeing signs of slowdown, and thanks to probably their zero threshold on COVID in China, and also we're seeing a bit of a slowdown in Europe as well. But India, of course, is we are seeing signs of green shoots of recovery. So, and you touched upon this a little bit as well. But what do you see India relatively to the overall global ecosystem?
So let me tell you the risk factors, I think, first, because I think we all know the positives, but I think the risk factors of this is that obviously it kind of goes without saying that the vaccination program has to continue at this pace. Hopefully we don't get a third wave until there's any more further lockdowns. And of course, the monsoons haven't been great either. Now, I know year after year, we talk about the monsoons, but again, if it just impacts the rural economy at a time when you're trying to get people to spend, would be, some of the negatives that you could have. Think about the auto companies. We've all been reading, right, that they're under pressure. So for them, they get hit on many different fronts. One, lower demand. So your revenue falls. Your operational gearing, because you're still employing those same workers, obviously gets squeezed on the way down. And your input costs are going higher, and you might not be able to pass it on. So your earnings get hit, right? So that's really, I think, from a kind of a more one sector in particular. But when I look across, I think there's growth coming through from many, many different places. We've been, many years back now. I keep forgetting time because the pandemic just takes a couple of years off you. But we've been saying that affordable housing at some point will have that catalyst effect of people saying, okay, I bought this affordable housing, 1 bedroom, 2 bedroom, now I want to move to something bigger, right? So you kind of move up that chain. And prices of real estate will go higher, but we said that would help stabilize prices. And what we see now is obviously because of the pandemic and because people have more money and interest rates are very low in India compared to historical standards, we're seeing more and more people buying real estate. Do they need to be in the city anymore? Can they be outside? So all of these things are playing, a part in the increased interest in real estate again. And that has a multiplier effect across many different industries, right? From paints to pipes to windows to whatever it might be. So that again is a very, very strong indicator that the market and the green shoots are picking up, is what you said. If I look at the kind of what I saw in the hotels the other day, there was the other interesting thing was this. I met some diamond. I don't think he's a trader; he's more of a seller of diamonds, and he had a three-day event at the Taj. I said, "How was it?" He said, the interesting thing is that maybe the volume, the number of items being bought is not as much as it was. But because you have limitations on the number of people, they have more money to spend and buy bigger pieces of jewelry for their daughter or their son or whatever they're going to do. So they're actually spending more. And and you're seeing that across, other jewelry companies that are listed in India as well. So people are saying, okay, I have this disposable income, I can spend more, but I think that will continue. I think once the third wave doesn't happen, I think you'll again see lots and lots of people going out, trying to have experiences. And because we can't travel overseas at the moment, right, because of all the quarantine restrictions, the tourism in India is going to really pick up. I mean, if you try and book somewhere where there's a holiday, whether it's Goa or say Alibag, which is not very far from Mumbai, prices are astronomically high. I mean, they're just, you think, my God, I could go and stay at the Taj for the weekend with 1/3 of the price, right? So I think there's many areas which will see spending pick up. We haven't really felt that in India yet, but I think we're just at the cusp of it. So those green shoots, I think, we'll see it across many different industries going forward.
Yeah, I'm sure you were one such happy customer of the diamond guy for your wife.
I know. The good news was that they finished it. I think so. Okay. I met on the night after they finished, so I was very lucky.
Let's talk about this whole commodity bull run, right? And we have seen, and that has got always have a very big leverage, especially on the emerging markets. And we've already seen steel companies going up, steel, aluminum, everything, right? What do you think on the whole commodity bull run? Are we kind of middle of that rally? Are we overstretched? Because this commodity rally usually tend to be long term.
Yeah, no, I think it depends on this kind of scenario about global growth. I do worry about that. So you might have some weakness of commodity prices in the shorter term before starting to move higher. But whilst if you look at all of the the commodity players in India, particularly the steel companies, and they've gone from huge negative cash flow to having lots of cash now, and that's a cycle, right? So that's the great news. For India, though, we're price takers. We're not price givers, right? We don't have the global strength to kind of force prices. So you're really looking at China all the time, and what's China doing? So I think it's, for my mind, the commodity cycle still has more to go, but I think there will be some pullback if I'm correct on the kind of global growth slowing. And there's one other factor I think as well, which I wanted to mention, which is could impact growth. If you looked in the UK yesterday, they've actually increased tax through higher national insurance payments, raising $12 billion. They've also increased dividend tax. And that's the first start, right? That's to help fund the National Health Service. And they're still going to fund their deficits. So they've talked about it in the US. So at some point, we're going to get taxed more. I'm not saying in India, but I think elsewhere in the world. And again, that will have an impact on your spending power and growth, global growth. So that's what I think will bring prices down, right? If you look at lumber prices in the US, they went skyrocketing, right? And now they're down to, I think, virtually went to where they started.
Yep.
Now, I'm not saying that's going to happen with commodity prices, but if China is slowing, then it will have an impact in the shorter term. So I'm not saying it's a super cycle, because I don't know what a super cycle is. I mean, was last time a super cycle, or is this time a super cycle? But yeah, I think there's more to go, but I think short term worries.
Yeah, I think cycles are also getting shorter as well. So thanks to central banks.
True.
Yeah. We touched upon the the earnings upgrades, and we touched about earnings in India justifying the high valuations as well because of the changes in the index, or also because of the earning upgrades as well. We are seeing earning rise in India after a very long time, and now people are projecting similar run rate going forward as well. What's your take on the current valuation of the Indian market?
So the way I'm thinking about this, Raj, is that it's difficult to kind of see. If I just take historically, then the PE is way above where we've ever seen, right? Mm-hmm. In historical standards. But the constituents of that, in terms of the index, is something I'm trying to divorce myself away from, right? Now, why am I doing that? Because I should look at valuations. But I think there's sectors and companies. So let's just take asset management, for example. I think the PE is about between 30 to 40, right? Yep. But who would have thought, if I would have said to you a year ago even, one of these mutual funds will raise 12,000 crores in one new fund offering, you would have said, no way. There's no way that's going to, and this is a balanced fund, right? It's not a pure equity fund. So I think that whole savings, for people is going to continue to find its way through, SIPs or just pure mutual funds going forward. So I think that's a whole industry. So in 5 years' time, how big will this industry be? Was paying 30 times expensive today in 5 years' time? I don't think it's going to be, right?
Yeah.
So that's what you got to look at. So I think rather than say the market, the Nifty PE is this, you say which sectors within, I'm just taking Nifty, which sectors within Nifty are going to continue to have exponential growth over the next 3 to 5 years. And if I'm paying that today, is it going to be a similar PE in 3 to 4 years' time? If the answer is yes, you buy it. So I take a great. I looked at Nestle. I was looking at Nestle. I'm talking about 4 or 5 years back now. But what I did was I looked at Nestle and said, okay, 330 odd million people across Europe. What happened to their PE over the kind of 80s, 90s? That's when Europe was really kind of growing in terms of consumerism, different products. It was never less than a PE of 50. Right? It had some periods where when markets fell, so it fell along with the markets, but it continued to deliver that growth, consistent growth. So people paid for the defensive nature of the business, and plus they were seeing growth. I think that's what you've got to look at. So the IT sector, for example, a lot of people are saying, is it overvalued? Is it this? Now, by traditional standards, it probably is. But I think the world's changed in terms of how we use technology and what's happening. So if you take the US infrastructure bill, which has been passed, I think 65, whatever it is, $65 million. A lot of that money is going to go to building networks around the country. So what they found, obviously, is that, whilst, say, the likes of me and you living in the US would be able to have an internet and so forth. In the poorer areas, there's no connectivity. There's little people can connect. So they're going to spend a lot more on that infrastructure. Now, that's going to have some impact on technology, right? Somewhere along the line, not just for the people who provide the internet, but there's going to be cloud is going to be there. There's going to be different things, and all of this IT companies would be able to play a part. So. So in the short term, whilst you might see some consolidation in the share prices, I think you're going to continue to see rapid growth in terms of revenues for these companies, and possibly also consolidation in the industry as well.
I think you brought in the interesting point around, how to look at like IT still looks overvalued now, but going down the line, how will it look like given the, tailwind all of this industry's got? Let's bring in your view on particular sectors, right? What do you think, where you think the investors are over optimistic on certain industry, or where you think people are underestimating the potential of certain sectors? So just want to hear your thoughts on sectors.
So, I think sometimes it's a little bit more relative, right? Do I want to buy IT relative to, say, banking? And then you look at the prospects for each. And each one will have their own day in the sun, right? So if I was to say that the market correction was coming, and I could actually know the timing of that, I'm going to be more, my barbell approach, my barbell is going to be more towards IT, FMCG, pharma, right? And I'm going to have less weightage on those economy-facing kind of sectors, banking, metals, industrials, and so forth and so on. So I think rather than again say that this sector is going to do well and this sector is going to, I think there's many different themes playing through. We haven't talked about ESG, right?
Yep.
Now, if you look at a chart in the US of oil companies, versus the kind of, more kind of, kind of friendly kind of. I'm sorry, I can't remember what less fossil fuels. The graphs are like this, right? one's going up. So the green technology or green industries are going up and the oil companies going down. And that's going to happen here. And it is happening here. We're starting to rank companies on their ESG credentials, not just governance, but whether they're helping from a social viewpoint, do they have women on the board, so forth and so on. So it's a new theme that's coming through. And we launched the ESG fund many years back. One of the reasons I told people is that, see, if there's $35 trillion of funds under management looking at ESG, supposedly, right? I'm not saying that everyone is. When they come to India, they can't say, well, we're not going to use ESG. They're going to use ESG. And let's just say, the ranking, and they're looking at banks. I'm sure that HDFC, ICICI are going to be high on the ESG score. So money's going to go there, which is going to, it becomes self-fulfilling, right? That there's more money chasing the quality companies, particularly ESG. So I think there's trends within that. So if you think about the infrastructure spending that the US is going to do, it's going to be more towards green technology, right? It's going to be more towards friendly environment in terms of where they're investing, what companies are doing. And I think that's going to happen in India too. I mean, we're all getting excited on electric vehicles, right? And then the suppliers and components and so forth. That's going to be across all different industries. And it's going to pick out the new winners from that who are sustainable and have good corporate governance. So I think it just focuses the areas. So again, when you look at the sectors and say, do I want to be in oil and gas? First and foremost, do I want to be in oil and gas? If the answer is no, do I want to be in tobacco?
Yep.
Right? So you're excluding quite a number of sectors just on the basis of that. So that's one theme that I think will continue to play out. And I think the other thing in terms of where would I be? So this is not listed, right? But I'm sure you've been hearing about, a company goes for round A at let's say 5 crores valuation. 2 weeks later, it's 25 crores, and then it's 400 crores. So the private equity part of it, I think, it's got a little bit over the top at the moment. Probably not just in India, but elsewhere. But particularly from what I've been hearing from people talking around, that the private equity is a little bit hot, and people are worrying now because you put your first crore in at this valuation, then you're kind of committed to put more in at this valuation, and each time you're stuck a lot longer, right? So I think there's concerns over that, and if that could be not a bubble, but would have some kind of correction.
Yeah, I mean, all of this goes in cycles, right? We have seen this earlier, and this is happening again. But I think overall trend of this whole private money coming into the new age tech, I think there will be uptrend. Of course, we will have the extremes always, and we will have the corrections. But I think the trend will continue. And also, I personally think that thanks to what's happening in China, I think some of those money will keep continuing flow to India as well, given the talent here. Let's talk about your business. Let's talk about your business, at Avendus. And, we heard that you got the AIF license at the Gift City as well. So many congratulations on that. Let's help us understand, how do you see this whole, your business at Avendus taking direction? And
so, we have a number of funds. So we have, the Absolute Return Fund, which is a flagship product, the one we were doing at Merrill's in terms of the same strategy. And we have an enhanced fund, which takes, again, a little bit of the risk curve in terms of equity. It's give you good equity returns, but protect you on the downside. We have an ESG fund. And, all of this is domestic money. We're about $700 million overall in terms of assets under management. But we feel that foreign investors are looking at ways to kind of come into India, and obviously with our experience of the long short, we believe that we could attract funds into our fund into India. So, traditionally, you would look at your normal places to house your fund, which would be Ireland, Singapore, less Mauritius, but, those types of places. And then with Gift City, what we found was a number of things. One is that, they've done, in terms of the tax of your funds, it's really hard-coded into law now. So there's no worry about, could they change it? Could they change it? Will they change it? It has to go through law. And when you looked at the service providers, whether it's custody, your kind of NAV providers and so forth and so on, all the big names, whether it's Citi, Standard Chartered, are all coming to Gift City. So the big advantage is that one, it's the same kind of jurisdiction as if you were in Ireland, in terms of if you've got a fund, it's being taxed the same, there's no difference to anyone else. But your costs is, a lot lower to set up the fund in Gift City. And interestingly, we've had quite a number of foreign investors now about potentially investing in the fund. And whilst it might not have heard of Gift City, because of all of these elements being brought together, in terms of there's no change for them if the fund was in Ireland, plus all the same service providers that they use everywhere else in the world. It's given them a lot of comfort and therefore more open. I don't say it's going to be an easy task. It's going to take time for it to grow. But they're acting quick. They're acting very quick. I must admit, we'd said at the beginning, I've been in India since '97. I can't tell you that how quick the approval process has been from a regulator. It's been astonishing. I must say. I mean, I think they've been quicker than we normally get internal approval. So it's been a pleasure. They hold your hand and they take you through the process. So but don't forget, it's all SEBI, RBI is all rolled into IFSCA as a one body. So you don't have to go running around pillar to post to different parts of the organizations. So it's and of course they have they want to set up funds. So as you know, a lot of Indian investors will want to put their money outside of India, right? Yeah. So they have to kind of go to Singapore or through LRS or whatever it might be. Now you're going to have funds in Gift City, which can you can put your money there and it will invest in US or wherever it's going to be multi strategies, global macro strategies. So that I think a lot of funds sat outside of India, who want to attract Indian investors. I think Gift City will be a nice window for them to do so, because I can assure you a lot of the wealth managers, sat outside of India are looking at how can they get into India and get some of this money into offshore funds. And I think they'll say the easiest way is to set up a fund in Gift City and we can attract that money.
Oh, that looks like a huge potential there. I mean, I've heard great things about what you're mentioning as well. Let's talk about, since you run hedge fund, you of course do a long and short as well. What's been your best long and short calls till date? Just want to understand the thought process. Anything which didn't do
well? See, this is not, because we're in India. India's an emerging market, right? Yeah. So it's not like in the West where, a hedge fund would say, I can buy this and I'm going to sell this because this is going up and this is going down. Doesn't work in India because, you'll get rotation across different sectors and you get squeezed very, very quickly on the short side or your hedging side. So you have to be super active on that side. Because you can actually lose a lot more there than you can on your long side. Usually stocks don't go up 20% in a month, but you can get squeezed effectively there. So it's a very actively managed fund in that respect. But let me try and give you two examples of how it works for you. So many years back when we were long private banks and we were short PSU banks or hedging with PSU banks. And it was working well because private banks were taking market share every day from these PSU banks, and it's painful for PSU banks. And then the former finance minister, sadly not with us, Arun Jaitley, one evening said, "I'm going to recapitalize the banks, the PSU banks." So the next morning, you knew that all the PSU banks would be gap up, right?
Yeah.
And so we walked in that day and in the morning, and they were up anywhere between 15 to 45%.
Painful.
Right? Now, so we just covered those straight away. We didn't say, oh, it could fall a little bit during the day. We just covered it. And I'll come back to that in a second. I lost more money on the day on my long positions than I did on my short positions. And the reason for that is a numberfold. Is one, for any single stock, you can have a 10% weightage.
Yeah.
On the long side, if we've got high conviction, we can go up 5 to 6% weightage. On the short side, or the hedging, because you get squeezed effectively very quickly, and that's really for your market risk. It's not to try and say that stock's going down. Nowhere have we ever been more than 1.5 to 2%. Right? So you're not taking big bets on both sides, you're taking it more on your long side. I think the other thing to say is that we have very strong stop loss limits. Right? So let's say we buy something at 100 and it falls cost price by 15%. There's an independent risk manager who says, I don't care who's put that in the portfolio, it's going out straight away. Right? So there's very strong stop loss limits there to protect the portfolio. I mean, listen, me and you, I'm sure we've got some of those stocks in our portfolio which we think, at some point they'll recover and we'll make some money, right? Running a fund, you don't have that luxury that maybe you do to take those kind of personal views. So, those are the kind of things we do. I think the other thing that it's that worked well for us. It's some time back. But as you know, let me go more news. So when the pandemic happened, right, we did two things. First of all, we said, this is like 2008. Let's not take any big call, bullish or bearish going forward. Let's, go back into the market. And if we're making some gains and so forth, let's take it off the table, because you didn't know in that time how things would change. But what we did was, okay, we know that the economy-facing sectors of India are going to be under huge pressure. Banking, industrials, energy, commodities, all of those. Those are your hedges, right? Those are the ones which should underperform, should go down. And on the other side was those companies which would not be affected so much. IT, FMCG. I mean, we all had to go out and get some food, right? So we had to eat, right? So that's the approach we took. And so obviously we made money on this side, and this side did help us when markets fall, because these were the vulnerable sectors, to any kind of fall. Whereas these were defensive, they were going to be there. We still need to go and get some food. And then what we did is say, okay, that's all very well, right? That's your first initial kind of move. And then what we did was we put each of the sectors into a basket. So you had your financial sector, because it's so big, you had your financial sector. Then you had your defensives, your ITs, your FMCGs, your pharma. So it becomes an index, right, of these sectors. You had those sectors which would be beneficiaries of the lockdown, and those which would obviously be affected, airlines, stores. And by covering this index, you start to see, because we kind of followed what happened elsewhere in the world, which could start to see the interest come into these sectors, into these baskets of sectors. So therefore, you could start to shift around a little bit quicker than just saying, "Oh, I think economy-facing stocks will do better now." You were actually starting to see flows towards it as people started to say, "Okay, less defensive, a little bit more maybe banking, a little bit more maybe commodities, and you can see those indices starting to move. So it really helps us kind of weave our way through, unprecedented times. I mean, I've never been in a pandemic, so I didn't know how to react to it. So those are the kind of things that you can do. But generally, what we do is we say, what do we like? What is it globally? What is happening? How does that impact India? Because global interest rates, global commodity prices, and global currencies, whatever the outcome of that, will have an impact on India, right? If you think the oil price is going to 100, it's going to have a negative impact on India, right? So all of these things, so top down, bottom up, what is India's GDP growth? Which are the sectors which are going to be the drivers or the beneficiaries of our growth? Then which are those sectors which are going to underperform? Global factors, local factors, for example. So more recently, autos would be on your side of hedging, right? Because they've got a lot of headwinds in the very short term. Whereas on the other side of it, you might have telecom, because there's a lot of catalysts for telecom at the moment, whether it's Vodafone going out or Vodafone staying in, or government helping out. So those are the kind of things that you're looking for. But you're not necessarily saying that this stock is going up and this hedge is really for that market risk.
I think that's very interesting. And I guess, looks like of course, you have a very great thought process, and also some of the risk management strategies which you mentioned, which is about stop losses is number one. And of course, keeping the weightage in check, especially on the shorts. And we have seen short squeezes even globally as well, right? Recently.
Yes.
We are coming towards the last part of our podcast, and I have a couple more questions. And one is, as you know, that our show is actually called Breaking Investment Stereotypes. Any stereotypes you want to talk about? You have had a long career in investing, so do you want to bring in any kind of stereotypes which break here?
Yeah, well, there's a few actually, but just before I say that, when I talked about the fund, one of the biggest advantages I think we have is that, and you'll remember some of the names, Vaibhav, Sangvi, Piyush Shah. We've been working together now since 2005, so it's one of the longest kind of I think fund management teams who stuck together for this long. So it really does help. Now, going back to kind of, so in terms of investment thinking is obviously, is follow your own conviction. I think the problem we all have is that, there's too much noise around us. And so if I say to you, look at this stock, you might mention it to a friend, no, don't do that. Or if you do your own homework and it doesn't sound interesting, you don't follow through your own conviction. And I think that's one of the things I like to do. See, we all have strong views. It's all about whether you enact on them or not, and whether you feel you should. Now, running a fund, you can say, I expect this to happen. But what I try and do, for example, I'll give you an example. I think it's October 15. One of my newsletters wrote that I thought China was going to devalue its currency, right? I didn't know when. Right? October. Now, we know it happened in August 2016, right?
Yeah.
But in between that time, the markets went up. So if I would have shorted the market, right, because you think devaluation will bring markets down, which it did, I would have had to wait nearly 10 months to be proven right. So what we say is that, yes, have a high conviction. Forewarned is forearmed, right? So as soon as you see it happening, then you can act very quickly, or be positioned for it very quickly, or have hedged yourself enough for that. But all the evidence was there over that 10 months. Commodity prices kept falling. Emerging market currencies kept weakening. Everyone kept weakening the currency to be more competitive. And then finally that happened. So those are the kind of things, is have high conviction, but not necessarily say, I'm going to be right, because things could change.
Yeah, as George Soros says, right? I mean, when you have high conviction, no position is large enough. So, and you end up betting the house on this whole pound thing. Last question, and this is what we ask each of our guests. what advice you will give to your own 20-year-old self?
I think that would be the same actually. It's just follow what you really believe in. And let me give you maybe it's not a funny story, but it's a story. Mm-hmm. So I remember, when I was first starting off in the industry, there was I was in Manchester in England, and there was a number of brokers that were there, and I spoke to one of them. He said, you need to buy this company called Kandeka. Mm-hmm. So I said, okay. So I just bought some. I didn't look at it. I just bought because he's a good guy. I was watching the 9 o'clock news, and then it flashed on about this oil rig being on fire, and it was owned by Kandeka. And I'm thinking, my God, I just bought an oil company and the rig's on fire. So I couldn't sleep the whole night. Phoned him on the next morning. I said, why have you made me buy this stock? He said, what are you talking about? I said, the rig's on fire. I said, no, because there's this guy called Bruce Hansen from Texas who's just flown in. He's going to put it out. And that was the reason I bought it. So I think for myself at that time, I said, I was probably around 20. I said, I will never listen to someone else before. I will always do my homework. Yes, it's good to get inputs, but follow my own conviction. So I think that's why I'm saying it's probably the same thing.
Thanks a lot. Thanks a lot, Andrew. I think it was a very, I really enjoyed our conversation and looking forward to probably meet you sometime soon as well.
Yeah, no, it's been an absolute pleasure. Good to reminisce about the good old days at DSP Merrill Lynch. It's funny, whenever I meet people at DSP Merrill Lynch, they still put it, say, that was the best time. That's the best time I had. I think Amendra Qatari just got all the right people. Maybe it was that moment, but it was a fantastic time.
Yeah, we shouldn't get started on that. Otherwise, we'll need at least a couple of hours to talk about that. So that's probably over a drink. Thank you so much, Andrew.
Okay. Thank you very much for inviting me.